Hello and welcome to this Forex Preview at xm.com. We'll be discussing the upcoming inflation figures out of Japan and the outlook for the yen. I'm Maria Pachordes, and joining me is investment analyst Christina Parthenidu. So Christina, the Bank of Japan is the only major central bank that is refusing to abandon its super easy monetary policy, despite struggling to maintain its yield curve control. How do you think Friday's inflation figures will affect its judgment?
Hi, Maria. It's nice to see you here. Well, indeed, the Bank of Japan is still stubbornly supporting that its super accommodative monetary policy of negative interest rates and a restrictive yield curve is what Japan's economy needs at the moment, although other major central banks like the Fed are already well ahead on their rate hike cycle and have already signaled supersized triple rate hikes in July because inflation doesn't seem to be peaking yet there, and it started to look something irremovable. Even the Swiss National Bank has switched to the tightening side and raised its interest rate by 50 basis points, and while the ECB is having similar plans for July. So that immediately raises questions about how long will the Bank of Japan stay on the sidelines, because as you also have mentioned, the yield curve control, which the central bank uses to keep the 10-year bond yield at 0.25%, has started to become a real struggle, a real difficult task. Rising global bond yields are pressing Japanese yields higher as well, and that requires a huge bond buying from the Bank of Japan to press the yield back to 0.25%. For example, last week it took $8 billion of bond buying, which is a triple the ECB's monthly purchases and 20 times the Fed's pace in 2021. So as you can imagine, its balance sheet has become huge and was last seen at 135% of GDP. But according to policymakers, the central bank is still willing to continue its bond purchases and keep interest rates negative, even though monetary divergence between the Bank of Japan and the Fed has widened significantly, sending the yen to almost 25-year lows lately. But still, there is an explanation for that, and that it's simply inflation. Unlike other major economies, the core CPI inflation in Japan is still around 2%. Specifically, it was 2.1% in April, and is expected to remain steady at 2.1% in May as well. So technically, that is not a significant violation of its price target, and it's clearly justifying the central bank's dovish stance for now. Also, it has recently argued that monetary tightening may cause adverse economic effects and after a negative growth in the first quarter. So that suggests that the central bank may stick to its plan for now, but I suspect that the period may not be too long if the yen keeps falling aggressively. There was a division between policymakers about the sharp falls in the yen, which makes imported products more expensive for producers. So probably the central bank will remain in a wait and see mode and see how things will evolve in the coming months.
So do you think the Bank of Japan will eventually intervene in the FX market in order to help the currency move in the right direction?
Well, I wouldn't rule out that, and probably that will be its strategy, at least in the short term, since Japan is backed by foreign reserves and can use them to balance any sharp decreases in the yen. Its next policy meeting will be on July 20th, and that will follow the House elections on 10th of July, which the current ruling party is expected to win. So apparently the central bank didn't want to deliver a tighter monetary policy before those elections, but after that it will probably stay a bit patient and see how the recession risks will evolve. As everyone knows, the yen is a safe haven currency, so it tends to gain momentum when economic risks get larger. So apparently traders may not fully abandon the currency, and that may help it gain ground against the US dollar. However, if recession risks prove to be more soft, let's say, and manageable, then the central bank may will probably tweak its policy, likely abandoning its yield curve control first. Well, for now, dollar yen is still supported around 135.45, and perhaps a surprise in Japan's inflation. CPI readings on Friday will help the yen recoup some losses and therefore pressure the pair a bit, since investors are still trying to figure out how the Bank of Japan will navigate its policy in the coming months. Though given the central bank's strong dovish stance and its steady guidance, I think that any decline in dollar yen will be temporary for now.
Christina, thanks so much. And thanks for joining us at XM.com.